Good morning, everyone. I hope you can hear me. Welcome to the new way of doing business and communicating via virtual webinars. I think we're all getting used to this, and I think this will continue for the foreseeable future. For those of you that have not participated in a webinar before via Zoom, right at the top, you have a black bar with various buttons on it. In the middle of that bar, there is a Q&A button. You are more than welcome to enter questions while I'm speaking. And at the end of the presentation, I will take maybe 10 or 15 questions. I'll answer them if there is time. If not, all our questions will be answered in a Q&A sheet that we will circulate to everyone who has registered for this webinar and sat through it. So without much further ado, let me launch into the presentation. I have expanded the presentation a little bit because I have received a number of questions from various clients asking me to address various issues. So it's a little bit of a broader seminar than just talking about Sygnia Oxford Sciences Innovation Investment. So I think that the words, the winter is coming, are very appropriate, also in the context of this obviously season changing, but what we can expect in terms of South Africa and South African economy. I think no one is under any illusion or delusion right now that things will never be the same post-COVID-19. There is no V-shaped recovery in sight. This crisis literally has hit the fundamentals of every economy worldwide. And what is at the fundamental, at the core of every economy? Consumer spending and consumer behavior. And I think it will take a long time for that to normalize again. And for some people who are in lockdown right now, they might never recover from the psychological effects of what is happening right now, particularly if they have been personally affected by a tragedy. We obviously are all poorer, much poorer, and feeling a lot poorer. The problem is that the recovery will be very slow. There will be a lot of bumps along the road, lots of volatility, and of course the currency is where it is. At over 23 pounds to the rands to the pound, at almost 19 rand to the dollar. I don't think, those of us that are hopeful that at some stage the currency strengthens, given the credit downgrades, I don't think we're going to see that anytime soon. In terms of what governments are doing, obviously we all listened to President Ramaphosa yesterday announcing 500 billion stimulus package for South Africa. Most of it will be borrowed, which basically means that for the next 10 years, we as taxpayers in South Africa will be repaying that debt. So you can expect increased taxation, but it's not only increased taxation in South Africa. Governments worldwide are doing exactly the same thing, and so taxes are going up. I think sentiment towards people who are more wealthy is going to kind of dissipate, and there will be focus on wealth distribution. I have been privy to some documentation which talks to, and also, what Trump confirmed that yesterday, to the fact that most countries will not be accepting immigrants for at least the next 2 years. As a consequence, a country like South Africa can afford to, for instance, introduce a wealth tax on the wealthy, knowing that there is no exit strategy for the wealthy, at least, again, for the foreseeable future. I think volatility is here to stay. And really, the only investment antidote to volatility is diversification. I think we've all been a little bit shocked by the oil price dislocation. One of the questions was, can I talk to the price dislocation in the oil market? And it has been quite an interesting thing to watch, because I think, those of us involved in the investment markets have forgotten the fundamentals of what a derivative contract is, what a futures contract is. Futures contracts at their very core, before financial markets got involved and before they became instruments that were traded, were just contracts between two parties, one party producing oil, one party buying oil in future. And those contracts were entered into in order to protect the producer against oil price falls while he was undertaking his production activities, and ensuring that he will receive the price that he wants in 3 months' time. Of course, what has happened in the world right now, apart from the COVID-19 Black Swan event, we've also had the oil war between Saudi Arabia and Russia, with kind of no end in sight. So the world is pumping oil, and certain countries can't afford not to pump oil, such as Saudi Arabia. They depend on oil revenues. But at the same time, just look around you, no cars on the roads, no airplanes in the sky, which means that demand for oil has literally dropped off the cliff. Now, the actual futures market has been, a little bit of a speculator's game. A futures contract at its, as I mentioned, at its very core, there's actually oil. There's a barrel of oil being sold, and someone has to take delivery of that oil. In the middle, lots of market participants trading in those contracts. And a couple of days ago, we had those contracts usually are 3 months in duration. A couple of days ago, we had the contracts maturing, the futures contracts close out, as it is called, on the horizon. And suddenly people holding those futures contracts during the day realized that someone might be pitching up on their doorstep, asking them to take oil delivery. The world, by the way, has run out of storage for oil, for physical oil. So tankers are full, refineries are full, any kind of vehicles where you could store oil are full. And suddenly there was this incredible realization that those that are still holding the futures contracts and are on the buy side of this need to get rid of them at all cost. Because what are you going to do if someone is like literally putting on your doorstep with a tank of oil? And that is what you saw. You saw frantic trade in oil futures, which at some stage were trading at minus $37 per barrel, which basically implied that people would pay you $37 if you took the barrel of oil off their hands. And I think, again, that's one of those market shock events, which suddenly, after years and years of divorcing the reality of economies, commodities, away from financial markets, brought the two together again. And then one of the things that I think we must expect is that there will be amendments to Regulation 28, potentially to raise some of the money to fund COVID-19 expenditure. And then, as you all know, we have not escaped the COVID-19 virus. We have merely flattened the curve to almost nothing. And the moment the economy starts opening, and in all probability on Thursday, some lockdown measures, and I've seen the various proposals, some relaxations will be announced. But the moment that happens, the inflation rate is the infection rate is going to go up, and we are going to go along the same path as every other country, exponential. We are expected to peak in September, and the news will be terrible. And I think we all need to prepare for the fact that we will all know someone who passes away as a consequence of this. Corporate news will be terrible. Earnings are down, debt defaults, bankruptcies. So we're not heading into a positive environment. And, we might as well prepare ourselves psychologically for it now than wait for the future. Now, all of this really talks to fear. And what should you be doing from an investment perspective, given that it's now a fear-driven investing? And we do believe that this requires kind of a new way of thinking about investment strategies. Now, this is a slide that I put up not now. I actually did a presentation at the Singularity University conference in September last year. And I believe that, this is the future that the asset management industry is facing. I obviously did not predict COVID-19 virus, but I believe that what has happened now has just brought this kind of framework for how the investment world will look forward and accelerated the changes that are happening. So in terms of Sygnia's kind of popular investment paradigm, we believe that low management fees are here to stay and will become a greater focus for investors as we move into a world of single-digit returns and negative returns. The way of achieving low management fees is through passive investing, and that passive investing will eventually take off in South Africa. We believe that investors will look to buy exposure to the markets through cheap mechanism of passive investing, and then look for alternative investment strategies. So that is investment strategies which are completely not related to what the market is doing. And I'll talk to those, and that really is at the core of the presentation today, in order to earn alpha and to protect themselves against market volatility. And then virtualization of service delivery, of presentations, that's happening already. Right now in this presentation, you're sitting through a virtual experience. So why are low fees here to stay? Well, most importantly, cost is the only aspect of saving and investing that you can control. We have seen regulators come in and enforce greater level of transparency. Investors have greater access to information. That transparency that has been enforced on the financial services industry is validating some of the lack of trust that investors had in the industry, because suddenly being exposed to tiers of fees that you have never been exposed to before. And hence there is a growing awareness and expectation of clients that they get value for money. There's also the emergence, particularly in the retail world, of platforms which connect investors directly with investment opportunities, disintermediating many kind of mouths at the trough who charge extra fees. Technology is helping this. Social media engagements, people are validating their views on social media. Never let a good crisis go to waste. It means after this crisis, or as this crisis unfolds, there will be new entrants, new products entering the market. And I think, given how much value our investments have lost, we will all start looking at our final investment outcomes differently. We all know what pot of money we need in order to retire comfortably. The pot of money we have has just appreciated in value, and significantly so. So people will look at, particularly advisors, particularly boards of trustees, to reassure them that they have strategies in place to rebuild that wealth in some meaningful way. Oh, I apologize for that. I pressed the wrong button. So I think the concept of management fees destroying value. I always revert back to my favorite quote, and it comes from a paper called Charges in South African Retirement Funds, published by National Treasury, July 2013. They commissioned a study on the cost of savings in South Africa. And the quote is directly from that, and it basically says that a regular saver who reduces the fees that he pays on his retirement account from 2.5% to 0.5% per annum would receive a benefit 60 times greater at retirement after 40 years. So 60% of your pot at retirement would have been eaten away by fees. If you invested a lump sum of money, exactly the same equation, reduce your fees from 2.5% to 0.5%, after 30 years, you would end up with a pot of money which is 80 times greater. And hence, fees must become the focus. Now, one way of achieving low fees is to incorporate index tracking in the overall investment strategy. I am doing a webinar tomorrow specifically on passive versus active investing, and so for those of you that are interested, please join that. I've got some slides in this presentation which I've included based on some questions I've received. But I kind of feel that we really should get past this concept of companies like ourselves, who are huge proponents of passive investing, somehow always being on the back foot defending passive investing, whereas active asset managers, who truly should be on the back foot, are nowhere to be seen. Active asset managers are basically lambasting passive management, and passive management is defending itself. Actually, to be perfectly honest, and I'll show you a few slides, it should be the opposite. Passive management should be the default. Active managers should be defending themselves. So in terms of passive management, let's go to statistics. Passive management has won the performance debate all around the world. SAP runs a survey. It's available on their website. And it's called, if you Google SAP SPIVA survey, you will get a link. It's quite a lengthy link, but they have a survey on their website where they look at various geographies, and they look at unit trusts in particular, because unit trust performance is reported net of all fees, and they look at the general equity category of unit trusts worldwide, and they update their numbers every June and December, and they look at performance of general equity unit trusts over 5 years, 3 years, and 1 year. And the graphs that you are seeing basically show you the percentage of general equity unit trusts which have underperformed, not outperformed, underperformed the market index in each geography over rolling 5 years, and then 3 years and 1 year. So in the United States, 78% of actively managed general equity funds have underperformed the S&P 500 over 5 years. In South Africa, that number stands at 90%. And then if you look at other geographies, sorry, apologies, I just keep pressing wrong numbers. Other geographies, Australia 80%, Canada 88%, Europe 77%. You know, so if I invited you to a casino and I offered you the 80-20 odds of losing, would you play? But then, you know, there are still those among us that believe that we can choose active asset managers, that somehow we are different, that we've got a little bit of an edge. And there I always go to my favorite slide, which I call my asset manager fruit salad slide. And all we've done is we've looked at the Alexander Forbes Global Large Manager Watch survey, calendar years performance from 2007 to 2009. We've looked at, so these are the largest managers in South Africa, the global balanced regulation 28 compliant shop window portfolios that feature in the survey. And we've given each manager a different color. And so I'm not picking on Allan Gray for any particular reason, because absolutely every manager follows the same pattern. But if you just look at Allan Gray, 2007 somewhere in the middle, 2008 at the top, 2009, 2010 at the bottom, at the top in 2011, at the bottom 2012, and so it goes on in a zigzag pattern. So if I said to you, what is your bet for 2020? Who is going to be the winning manager, or the winning 3 managers? Let's make it easier. The winning 3 managers for 2020. Who do you think those would be? But then let's look at the arguments that active asset managers use against passive. And for the last 12 years, since the global financial crisis, the argument has been that passive investing is fine in bull markets, but active asset management will truly protect value in bear markets. That's when stock picking will come into its own. Well, this is the performance to the end of March. And again, I've used unit trusts rather than institutional surveys, because institutional surveys are show performance gross of fees, whereas here you've got much wider of a selection of funds. And I've looked at regulation 28 compliant high equity portfolios, in which Sygnia Skeleton 70 fund features. And as you can see, on a very short-term basis, just to show you the extreme of a bear market and how our skeleton fund has performed, there are 230 unit trusts in this category, and Skeleton 70 balanced fund came in 35th out of 230 funds. Over 1 year to the end of March, 23rd out of 222 funds. By the way, you might be questioning, and it was an interesting question, why 91 or Investec has done so well. And so I investigated it a little bit, because, you know, the numbers seemed very, you know, kind of, did they have a foresight into the COVID-19 situation? And it turns out that they did. Investec 91 has an office in Hong Kong. And so they were exposed in their Hong Kong office to the impact of COVID-19 much faster than obviously anyone else in the world. And the Hong Kong office warned London and South Africa about the impact, and hence they had not an unfair advantage, but they certainly had an advantage of earlier knowledge than anybody else of what was about to unfold. But someone said to me, well, is skeleton strategy where we as Sygnia do employ passive index tracking funds as underlying asset class specific building blocks, but we also deploy active tactical asset allocation. So we swap and change between equities and bonds and international and cash, whether that's a fair comparison, because we are fairly good at asset allocation. And here I revert back, and I'll answer that question just now in terms of looking at asset-specific performance. But I truly enjoyed one of the arguments made by Coronation, active asset manager, and Karl Leinberger, the chief investment officer of Coronation, in October 2016, said that asset allocation is generally accepted to be the most important investment decision. The gains or losses from selecting the right or wrong equity manager will typically be dwarfed by the gains or losses stemming from the right or wrong asset allocation decision. Asset allocation is the big call, and you need to get it right. Well, if you have an active asset manager who says stock selection isn't worth much, it's all about asset allocation, then why are you willing to pay an active asset manager almost twice, if not 3 times as much as you would pay for a skeleton balanced fund, where really it's all about asset allocation? Why are you paying that extra premium for an active asset manager? Well, I assume that extra premium in terms of fees relates to the amazing stock selection skills. But as per their own admittance, stock selection is not that relevant in terms of the final outcome. And then just looking at, I apologize for the kahiso, just looking at longer term performance, skeleton 70 balanced fund over 3 years to the end of March, 12th out of 179 unit trusts, and over 5 years, 19th out of 122 unit trusts. So I rest my case. Coronation, by the way, came in over 5 years at 49th. But let's talk about asset class specific performance of passive funds. So let's forget asset allocation. How do asset class specific funds have held up during this period of crisis? So just looking at general equity unit trusts, 1 year, 3 year, 5 year performance. Sygnia iTrix top 40 fund, index tracking top 40, 18th out of 215 unit trusts in the general equity unit trust category. SWIX 40, 30 out of 215. The full replicated SWIX index tracker, so that's 180 odd shares, 56th out of 215. And then if you look at longer term performance track record over 5 years, again 35th out of 128 funds, 54th out of 128 funds. So again, one needs to question, why would one pay so much extra for active equity management? And if one looks at, I apologize for that. If one looks at global equity unit trusts, so now we're looking at international funds. And as you know, international funds attract even higher fees. Actively managed international funds attract astronomical fees, particularly as they are, in the context of being managed by South African asset managers. We have number of passive funds and passively managed funds in this category. And our FANG Plus equity fund is 2nd out of 81 funds over 1 year. S&P 500 index tracker, 17 out of 81 funds. Just looking for Ellen Gray Orbis, 56th. Our Fourth Industrial Revolution Fund, 28th out of 81 funds. If one looks at a longer term track record, again, just the S&P 500 index over 5 years is 13th out of 55 funds. Ellen Gray charging about, I think our S&P 500 ETF charges 10 basis points. Ellen Gray, I think, charges 1.5%. So you really have to question, particularly in the context of international investments, what are you paying for when you appoint an active asset manager? And here, asset allocation is not a feature. Here, I'm talking purely to asset class specific index tracking funds. But I'm not alone. Internationally, I've just taken an extract of various headlines that have appeared in Financial Times over the past 6 months. And literally, I couldn't find one which says, passive money moving back to active. Absolutely every single headline talks to world's biggest pension funds are moving to passive investing boom. UK active fund managers suffer a bloodbath in 2019, and so on. So this trend towards passive investing has been a very huge one internationally. We obviously as Sygnia have been big proponents of using passive investing, at least as part of an investment strategy, if not the entire investment strategy. And I think what has happened in our financial markets will just accelerate the trend. So, if I look at the world of investing as it is now in South Africa and where it's moving, this is what it looks like right now. Long-only active management forms the bulk of assets being managed in South Africa, with passives on the side, some money in hedge funds, and don't get me on the topic of hedge funds, private equity, real estate. This is where I think we're going. We're going to a world where investors will buy the market on the cheap, on one hand. So that's your passive strategy, smart betas, or AI-driven strategies, quant strategies. And on the other hand, they will look for alternative investment options, which are not correlated to the market, to diversify risk and to earn positive returns. And they will take a much longer term time horizon in those strategies. But the potential for positive outcome and not being exposed to the volatility of the market will be something that investors will be willing to pay for going forward. And so what sits in the alternative space? It's investment strategies such as infrastructure or commercial real estate, not hedge funds, although they position themselves there, private equity, ESG type investing, impact investing, venture capital type investing, which is what I will talk to in a second. And then obviously the platform time delivery, I think that we've already had moves towards this concept of investors will interact with us differently, whether it's on the retail side, institutional side, where this kind of face-to-face contact will be less, virtualization will be more. And again, this is a slide that I put up not today, not for this presentation. I put that up in September last year without knowing of what's coming. And of course, here we are today. And I think, most of you will admit that going forward, you will prefer to have these kind of interactions where you don't have to get out of your pajamas if you don't want to, than necessarily, coming into a boardroom and sitting in close contact with other people for hours on end. So in summary, before I move on to our latest product that we have launched, we do believe that asset managers will increasingly give away these kind of cheap, passive, beta-oriented products, while at the same time earning some profit out of alternative investment strategies. And then, my favorite quote has always been one from Dwight Eisenhower, who said, "Neither a wise man nor a brave man lies down on the tracks of history to wait for the train of the future to run over him." So in the context of that, we've always at Sygnia thrived on this concept of innovation, particularly in the sphere of investments. On the passive side, we are the largest provider of ETFs on the JSE, strong supporter of passive. I've always been a believer. I personally managed my first passive fund at Southern Life, for those of you that remember Southern Life, in 1992. That that ages me a bit. But we've launched products that talk to innovation and the themes that we can see as taking over the world. So we've got our Fourth Industrial Revolution Global Equity Fund, which has done extremely well for our investors, the FANG Plus Fund, which invests in Facebook's, Apple's, Amazon's, Netflix, Google. So again, doing incredibly well in these tiring times. The Berkshire Hathaway Fund, just to give investors exposure to Warren Buffett. And the latest fund we launched in May last year was Sygnia Oxford Sciences Innovation Fund. And it's interesting, we launched the fund without obviously having any insight of what is coming, but it couldn't be a more appropriate fund for the environment we find ourselves in today. So Sygnia Oxford Sciences Innovation Fund, or Sygnia OSI Fund, focuses on impact investing. And the strategy of the fund is to deploy 100% of the capital to generate socially impactful and sustainable long-term returns, where exceptional performance goes hand in hand with changing lives for the better. And when I talk to the strategy of the fund, you will see, why it is such an impactful statement given what we're living through right now. So what is impact investing? And one of the questions I got ahead of this presentation is, well, who determines what impact investing is? And in fact, in 2015, United Nations published their Global Sustainable Development Goals, which are an underpin to impact investing and ESG investing. And really, it boils down to 5 pillars of things that everyone on this planet should have affordable access to. And that is healthcare, education, inclusive finance, housing, and then a focus on climate change. So if you're looking for what is impact investing, what is true ESG investing, those are the 5 themes: healthcare, education, inclusive finance, housing, climate change, and making that affordable for the masses. And the climate change obviously has an impact on the way we generate energy and we pollute our environment or don't. So what has happened since 2015 is that many of the technological advancements that we are seeing, particularly in the fields of AI and machine learning, have made what previously was not achievable much more achievable today. Impact investing, up to date, and I believe this is going to change, has largely come from millennials and from high net worth individual investors who are looking to make a difference and leave a positive legacy behind. In terms of climate change, we have seen regulators looking to institutional investors, such as retirement funds, to start deploying capital in a more socially and environmentally impactful manner. Because at the end of the day, most of you as trustees of retirement funds know that as much as ESG might matter, at the end of the day, the members of retirement funds will look to the performance that they earn rather than whether they're making a positive impact on humanity. And you will be accountable for that performance. So really the framework for almost forcing investments into these impact investing spheres had to come from regulators. It wouldn't have naturally come from bottom-up investors. And we have seen FSCA in South Africa come up with ESG directive in June last year, and some asset managers have started responding to it. But and there are different ways of, by the way, in terms of impact investing, there are different ways of responding to it. The simplest way is called negative screening. So that's basically where you look at companies and you naturally exclude anyone, who is involved. Companies like BET, tobacco, alcohol, armaments, and that's it. You're fine. Positive screening is where you start designing investment strategies with a particular focus on companies which, internally to themselves follow ESG principles. But there is a company that I came across which rates globally, has looked at the ESG rankings of all listed companies worldwide. It's a company, again, they've used artificial intelligence, machine learning, deep data to come up with this analysis and with this analysis framework. And it's quite a sound framework. There are lots of factors that they take into account. And I met with that company in London and I said to them, well, have you analyzed the South African listed market and the JSE and companies listed on the JSE in terms of the ESG score? And they said to me, oh, yes, no, absolutely. Pressed a few buttons and put up the South African companies in terms of their internal ESG processes and policies and how they rank relative to each other. Guess which company came out on top? Sasol. So that in itself, this ranking and self-ranking, self-assessment by companies is not good enough because, it can land you in absurd positions. So from our perspective, if you are talking about true impact, you want to make a true positive impact on humanity. And this is really where the Sygnia OSI fund comes. So Sygnia OSI fund invests in, and I'll talk a lot more to what this is in a second. It invests in shares of a company called Oxford Sciences Innovation, which in itself owns effectively 25% of all rights to the IP originating from the University of Oxford. So any research that is done at Oxford by any academic or an academic team, and it might be 20 years worth of research, and I'll give you some examples just now. Usually the commercials of that research are such that the academic staff own 50% of the rights if there's a patent registered, and the university owns 50% of the rights. But universities by themselves are actually absolutely terrible at turning patents into companies, into commercializing all that IP that they are creating. And so in the UK, 2015, a group of leading asset managers approached Oxford University and said to them, we've got all the commercial expertise, you've got all the IP. How about the following deal? When you register a patent, because it's truly worthy of registry, academic staff owns 50%, Oxford University owns 25%, and Oxford Sciences Innovation owns 25%. Oxford Sciences Innovation will inject capital into that patent and turn the patent into a company. And hence, instead of owning 50% of a patent, which might be worth very little, you as Oxford will end up owning 25% of a commercial venture. And that has been hugely successful. And since 2015, 80 different companies have been formed and spun out of OSI. In terms of Sygnia OSI Fund, we have acquired shares both in Oxford Sciences Innovation and the company, as well as, we're looking at in time when the spin-out companies themselves are raising capital. If those companies are interesting, we would select some of those spin-outs to invest in directly, if possible, because again, I will talk to this just now. So the fund was launched in 2019. It is 1.7 billion in size, and we have just received a further commitment of 2 billion from South African institutional investors to be deployed in the fund. The investment target of the fund is 3 times capital growth in 5 years, and that is actually premised on very detailed projections and valuation methodologies. So this isn't a random number pulled out of the hat. It's based on what the various companies are doing in their particular space. So why focus on Oxford? In terms of the survey that ranks universities in the world, Oxford is regarded as one of the world's 6 super brands, alongside Berkeley, Cambridge, Harvard, MIT, and Stanford. Most importantly, it is regarded as #1 research university in the world. It has 29 science faculties, over 12,000 researchers and academics. And then, and again, I'm not going to for a second pretend that in May 2019, I thought that, what is happening will happen. But its medical science division is rated #1 in the world for clinical preclinical health subjects and has been rated #1 for the past 8 years. So most of the patents originating from Oxford University touch on effectively 3 fields: healthcare, more widely life sciences, and then artificial intelligence. Oxford is also the leading university for artificial intelligence research. Oxford itself spends £700 million per annum on research and development. So that literally goes into development of new ideas, new patents, and supporting that research. And OSI benefits from that spend for nothing. It has the largest volume of world-leading research in the UK, and most innovative ideas originate out of Oxford. Now, in terms of OSI itself, as I mentioned, it was launched, the company was set up in 2015 with £600 million in capital. Over the last 5 years, it has deployed 250 million of that capital into 80 spinouts. It still has 390 million pounds in cash. So that's OSI itself. So it has a lot of firepower to keep supporting research originating out of Oxford. And as I mentioned, the commercials of it are very simple. OSI commercializes the company, and Oxford University maintains a stake both in OSI as well as obtaining a stake in the underlying spinout. And obviously, as OSI and other companies enter and provide more funding to the spinout companies, Oxford University's stake in those spinout companies is diluted. OSI's share usually ranges somewhere between 30 to 50% of each spinout. So this is a powerful graph. It just shows you the number of spinout companies that have originated out of Oxford since 2015. And more spinouts have happened in the past 5 years than in the previous 700 years of Oxford's history. So this is how patents of Oxford and Oxford research and Oxford innovation is turned into a commercial proposition that one can invest in. Through our acquisition, Bravos funds are just the names of the funds that we have registered in Guernsey to hold these investments. We've acquired 15.6% stake in OSI, and we are the largest shareholder as it stands in Oxford Sciences Innovation. I think there is something kind of quaint about the fact that, you know, South Africa owns Oxford University, but, you know, that's just me. What that gives us, most importantly, it gives us a seat on the board of Oxford Sciences Innovation. You know, up until last year, OSI was a closed club. No one was selling those shares. But there were some active asset managers in the UK who came under stress of outflows and poor performance last year. And all of a sudden, they became forced sellers of everything that they owned. And so we were quite quick out of the starting blocks. We approached a couple of those managers and bought their stakes in OSI. So these shares never hit the open market. It was a transaction. And, you know, we were very fortunate to get in there because there are no sellers of OSI shares. This was a particular situation created by a particular set of events. Other investors in OSI that you might recognize: Lansdowne Partners, one of the large asset managers in the UK, Invesco, Sequoia, Temasek, and University of Oxford itself. And then, more importantly, you know, it's one thing for Oxford and OSI to support Oxford, but do the spinouts attract external capital? And here you can see that some of the spinouts have attracted some of the largest brand names in the investment industry, from Goldman Sachs to Google Ventures Fund to Sequoia Capital, which is the largest VC fund in the world, and then to many pharmaceutical companies. So, you know, because all of those, a majority of the spin-out companies focus on healthcare innovation and on life sciences, it's important for them that they partner over time with large pharmaceutical companies with very large budgets, which can help them to leverage their innovations. And again, when I talk to examples of the investments, you will get a better sense of what these companies look like and what they do. So why OSI fund now? Well, one is UK has always lagged behind US in terms of commercializing the IP coming out of universities. I have a very good friend who runs Sequoia Capital, ex-South African, based in Silicon Valley. I went to see him in September, and he took me down. So Stanford University is based in San Francisco, Palo Alto, and he took me, drove me down Sand Hill Road, and literally Stanford University is surrounded by venture capital firms like vultures, waiting for ideas to come out of that university, vultures. Whereas Oxford has none of that. So UK is still at a point where one can invest in great opportunities at a reasonable valuation. The timing of the investment couldn't be better. We are at the bottom of the investor confidence cycle. So just valuation levels are very attractive. I don't think anyone will argue that the next focus for investors and governments will be healthcare provision. And that has a particular nuance to it. And that is that any company involved right now in any form of healthcare innovation, reducing the cost of healthcare provision, receives a whole lot of government funding. And it receives those grants for free. So those companies don't even have to raise capital from investors and dilute their existing shareholders. They literally are given grants. And again, I'll give you an example in a second. OSI itself, as I mentioned, benefits for free from the £700 million that Oxford University spends on research and development. And OSI has an exclusive in perpetuity relationship with Oxford. So no other company can come along and strike exactly the same deal. OSI has the cash to deploy and hence can deploy it at will, where it sees value. And to date, valuation of OSI shares has been extremely conservative. As the largest investors in OSI, we do have a board seat, and that gives us access to all of the OSI's research. OSI itself employs a very large investment team, and we have access to all of the investment research. We have access to the spin-outs themselves, to the management teams. We literally are the largest owners of OSI. And that means that, not only do we have access to spin-outs, but certain spin-out companies, the most successful ones, will never come to the market until they list. And the reason they won't come to the market, and I'll give you an example of Evox, is because along the line, they will strike commercial deals with suppliers of capital, which will not require them to raise capital from external investors. Through our stake in OSI, we will get exposure to companies such as Evox, whereas direct investment in Evox would not be possible in any other way. And I'll talk to Evox in a second. So let's look at Evox. Evox is one of the spin-outs, and what it has done is it has developed a method of delivering drugs utilizing the body's own exosomes, so it's little particles in your blood which travel around. They have developed a method of attaching drugs directly to those exosomes to ensure to then target that drug at a particular point or organ of interest. So, effectively right now, if you think about how you take drugs, you swallow a pill and you hope that that pill somehow finds its way to your kidneys. Whereas what Evox has developed is a methodology of literally attaching the drug via injection to the exosomes, and that exosome will take that drug directly to the kidneys without having to bypassing this kind of dilutive effect of a pill swallowing and a stomach dilution. In 2020, so right now, despite the chaos, chaos happening around us, Evox entered into a strategic partnership with Asia's largest pharmaceutical company, Takeda, which has agreed to inject $882 million into Evox. $45 million have already been injected. $882 million into Evox on achievement of development and commercial milestones. So that's a company which last time OSI valued its 45% stake in Evox, that the whole company was valued at $60 million. Now you have a capital injection of $882 million into that company. Evox will never come to the market until such time as they list, if they list. But the value creation has already happened. Another company, OSI, has created a portable diagnostic device based on 30 years of research by some of the leading professors at Oxford, where they can diagnose various diseases. In particular, they right now focusing on, again, heart attacks from a drop of blood in about 10 minutes. Again, OSI has a 33% shareholding in that company. Last time the company was valued on its books when it raised capital, it was valued at 30 million pounds. It's about to raise capital and the valuation of the company is 100 million pounds because they have progressed so far, in terms of the development of the technology and have proven that the technology works. Another company, Ultromix, much simpler concept, diagnostics of coronary artery disease, which is the biggest killer of men, by the way, over the age of 40. So to date, you have your ultrasound, and it's literally a black and white image, and you have someone, your medical doctor eyeballs that image and diagnoses you with heart disease. What Ultromix has done is they've developed a machine called EcoGo, which is premised on big data and artificial intelligence. And you feed the ultrasound into the machine, and the machine extracts 80,000 data points from that ultrasound scan and diagnoses, the condition of your heart effectively. So the technology itself reduces the error rate in diagnostics by more than 50%. And the company itself has FDA approval. It has struck distribution deals in the US with the Mayo Clinic. Again, last time Ultromix raised capital, the company was valued at 13 million pounds. It doesn't need to raise capital right now because of its deal with Mayo Clinic. But again, the valuation of the company right now is closer to 100 million pounds than it is to the 13 million pounds at the beginning. And then probably the most interesting company in the portfolio in OSI right now is Vasitec. And those of you that do devour newspapers might have read about Vasitec, or more importantly, you would have read about Oxford University's development and potential development of a vaccine for COVID-19. So Vasitec itself was spun out of Oxford in 2016. And two of the leading professors of immunology and vaccine development and vaccinology were the two founders of Vasitec. And in particular, Adrian Hill was involved in all the vaccine development trials for the Ebola virus in 2014. So there's a whole lot of long words here, but what it boils down to is that they were very far advanced in developing vaccines for MERS and had hell of a head start on any other company in the world racing to develop the COVID-19 vaccine. Already, even before this crisis, Vasitec co-investors, apart from OSI, co-investors in Vasitec included some of the leading institutional investors, Google Ventures, Sequoia, Lion Trust, which is a Korean company. OSI owns 45% of Vasitech. In April, right now, Vasitech received £25 million from the UK government to fund its clinical trials. It went into human trials yesterday, which obviously is still not a guarantee of success. But the reason they had, as I mentioned, such a head start is because of all the work that they were doing on the MERS coronavirus vaccine. And there they were already in phase 1 trials for the vaccine. Professor Sarah Gilbert basically said that she believes that they have an 80% probability of success, and that the vaccine could be delivered by September. Now, this company, last time it has raised capital a couple of times. It has raised capital when it was valued at £10 million, £26 million, and the last capital raise has valued the company at £70 million. OSI owns 45%. This is before the COVID-19 vaccine. Now, the COVID-19 vaccine is a problematic issue because it cannot, while there's a pandemic raging on, Oxford University does not want to be seen to profiteer from should it be successful. And obviously there's still a question mark over whether they will be the first or whether their vaccine will work. But if it does, Oxford University does not want to be seen to profiteer from a crisis of this nature. So the concept for Vasitech is that all these vaccines will be, as long as the World Health Organization declares COVID-19 to be a pandemic, the vaccines would be provided at cost, and the company has now struck commercial manufacturing deals with 15 large pharmaceutical companies all around the world. As long as it's a pandemic, no money can be made, so the vaccines will be distributed at cost. After it's no longer a pandemic, the vaccines would be sold on a commercial basis. So this is the quality of science emerging out of Oxford University that we have access to. Now, who makes the investment decisions on behalf of Sygnia OSI Fund? Well, first of all, as I mentioned to you, we have access to all the research that the investment team at OSI does and performs. And that is a very, very large team of investment professionals with, many of them with PhDs, many of them being Oxford luminaries. And hence, they've got an affiliation for Oxford. And they all focus on different area of research. So it is a large team. And, the research reports are provided to us. We then have, in terms of Sygnia, we have formed an investment committee in the UK, in our UK office. And Andrew Crawford-Brandt, who is one of the large shareholders in Sygnia, but also has been one of the founding investors in Oxford, or in OSI since 2015. So he was there right at inception. He's got a long history. He runs his family office in the UK. He has a very long history of investing in unlisted, privately owned companies, and a very successful history. So again, he's been involved in this Oxford ecosystem since 2015. He invests and sits on a number of boards of the spin-out companies, and he is a board representative on the board of OSI itself. Apart from that, Mark and Dominic were founding members of something similar to well, not quite the same as OSI, but Imperial College, London Imperial College, hired them to originate a similar idea to OSI, other than there weren't external asset managers involved. So Imperial College wanted to set up this, what's called an accelerator, which is basically, or accelerator company, which again commercializes IP originating out of Imperial College. They left Imperial College in 2016 to set up their own company called Deep Sciences Ventures. Andre is an investor in Deep Science Ventures, and they form part of our investment committee. And then I sit on the investment committee as well. But just to give it a little bit more, not credibility, but sanity check. You know, obviously what one is involved in is investments in healthcare. And, you know, none of us can pretend we might be investment professionals, but we're not experts in the field of healthcare provision. And consequently, we also have a scientific advisory panel, which is headed up by Professor Edward Peel, who used to be the Deputy Dean of Medicine at Oxford and then Dean of Medicine at Warwick University. And in 2017, he was asked by UK government to develop a new branch of medicine, and that is digital healthcare provision. So that is things such as, you know, virtual doctor, so virtualization of medicine. He also sits on the committee which awards Nobel Prize for Medicine. He's, you know, I think he's got eight PhDs last time I checked. Huge amount of awards. I think he's won every single award available in the field of medicine, and is right now advising the UK government on their dealing with the COVID-19 crisis. So he heads up a scientific advisory panel, and the idea is that every single spin-out, should we wish to invest in it, he will set up his own panel of experts that he believes are appropriate to evaluation of the investment opportunity, and he will produce a report for us which purely focuses on the applicability of whatever that spin-out company has developed in the real world. Because, you know, there's a huge divergence between the real world and the world of academia, and whether, you know, the machines or the innovations that originate out of Oxford via spin-outs will be applied in the real world. They might have applicability, but will they be used? So why Sygnia OSI Fund? I think we've got, between the OSI team and our own panels, a very successful and a strong team supporting this investment. At the end of the day, you know, owning the IP of Oxford University in perpetuity is not a bad investment. OSI aims to spin out 10 new spin-out companies every single year. So this is a growing portfolio of companies. You know, it's, at the moment there are 80 companies, but you know, each year there are 10 new companies added to that portfolio. Through OSI, we already have access to those 80 companies, and through that investment, we have access to its undeployed cash of £390 million. I don't think I need to tell you that it is the right sector for the right times. Healthcare, biosciences, technology-driven innovation in healthcare will be the main focus. And again, I reference you back to what is impact investing. Impact investing is exactly this. We are investing alongside some of the most prestigious names in global asset management. And we do believe that all, you know, that all those spin-outs are and can be defined as true impact investing on humanity. And yet it's such, you know, it's an investment which is completely diversified. It's also not an investment that has anything to do with the movements and volatility of the market. It is valued on the basis of the underlying IP and valuations of underlying companies, which do not move with the movements of the listed markets. And just to give you an idea, since we invested between May to the end of March, the fund has returned 23% return versus S&P, this is in rents, so with rent appreciation, versus 7.9% of S&P 500. Given what has happened with Evox, Vasitec, a couple of other companies which have been actually sold out of the OSI portfolio, we expect that the company will revalue its shares in the next 6 months by around 20%. So that's really it. Just very quickly, a couple of slides on Sygnia. We're very proud of what we're building. We are growing, and you know, some statistics, more and more retail investors are using us. Our umbrella fund is growing at an exponential rate. We do have over 900 institutional investors in our stable, and we now have an office in London as well. And this is a graph, I look at it fondly because I think, by the end of March, those assets under management would have come down, not because we're not attracting assets, but because of what is happening in the markets. But irrespective, we do continue to grow, and that growth is a function of what we delivering to clients. And so thank you very much. Thank you for listening to me, and thank you for your support. It's key, critical that at times like this, we communicate with each other and that we develop new ways of communicating and engaging. I've got some questions that I'm very happy to take. One question here is, why is there such a difference between 10x and Sygnia performance year to date in 1 year when both are low cost passive? So we have significantly outperformed 10x over all time periods. And the difference really is you're looking at global balanced portfolios. And the difference boils down to the fact that we deploy active tactical asset allocation. And because Sygnia has always focused, we haven't focused our investment process on stock selection. Our entire investment team has always focused on the analysis of macroeconomics. That really is at the core of our asset allocation strategy. I think, we've developed the skills and the expertise and have proven so to make the right judgment calls around asset allocation. 10x portfolios, it's my belief, passively held or have passive asset allocation strategies. So, the high growth portfolio might have 70% exposure to equities, and it will hold 70% exposure to equities at all times. So that's really where I think that the main difference is. And also the type of indices we deploy. So for instance, in skeleton balanced funds, if you look at our international exposure, which is 30% of the fund, we deploy all of our different funds, the Fourth Industrial Revolution Fund, the FANGS Fund. And again, we manage that exposure to different indices quite actively, whereas I think 10x only holds an MSCI World Index. So history, another question. So history has shown, and data shows, passive managers outperform active managers over significant periods. What needs to happen for investors to actually believe and invest in passive managers? Incredibly good question. So, one of the problems has been that active asset managers in South Africa in particular have had hell of a head start in terms of marketing to passive managers. So we really haven't had a massive emergence of, there are only 2 passive managers in town, and 10x is in its own niche. There is Cetrix, Sanlam, and ourselves. And, the outfits such as Coronation, Investec, Allen Gray would go back to early 90s and even earlier than that, have spent enormous amount of money on marketing, billboards. You have driven past all those billboards saying Investec #1, Coronation #1, Allen Gray #1. I mean, there's never a billboard which says Coronation, bottom performer. And as a consequence, it's in the investor's psyche to believe that that's where they should place their money. But I firmly believe that that is changing. That is certainly in the United States, more than 50% of institutional retail money is now managed on a passive basis. In the UK, the number is over 30% and growing. And the same trend will keep, hit South Africa. The more publicity there is around passive management, the more support there will be from investors. Magda, if clients have cash and are keen to invest, how much weight should they place on the week of exchange rate in terms of trying to get a decent entry point? I was hoping no one was going to ask me that question, because I was looking at my own retirement annuity just before I did the seminar, and I was asking myself exactly the same question, because I actually, in the markets, and again, not for any particular reason, and I'm not a genius at investing, but in terms of my own array, earlier in January, I became very concerned about the overvaluation of the US markets in particular. And I just thought, I really can't afford to given my life stage, and I'm not 25, I need to take some risk off the table. And so I literally reduced my equity exposure to less than 20%. I invested a lot in the OSI portfolio. But that means that I'm sitting on cash. And I've been looking at the exchange rate and looking at the exchange rate saying, what are the chances of the currency strengthening? And, I don't see it. And the reason I don't is, never mind, we've gone through credit rating downgrades and significant ones. Just think of the impact of last night's announcement. We are about to borrow, 130 billion will come from reprioritizations of expenditure, but we are about to borrow roughly 330 billion rand from external institutions in dollars, not in rands, in dollars. And we have to repay that money. I apologize, sometimes internet fails us. So the strain on the fiscus will be substantial, which basically means, our yields will remain high, our cost of borrowing will remain high, investor confidence in South Africa will remain low for the foreseeable future. And all of that doesn't talk to a strong currency. It talks to a weaker currency. So, without being too specific about entry points, I do believe that this is the new norm for our currency for the foreseeable future. Are you working on a vehicle to access OSI using hard currency? The vehicle already exists. So you can access the OSI fund either through a portfolio in South Africa or directly as a limited partner coming into the funds listed in Guernsey. We are also listing a unit trust in Ireland, which will invest in the funds we have listed in Guernsey for small investors in the retail space. So, there are two access points right now, the hard currency point via Guernsey, the rand currency entry point through South Africa, and then there will be also a unit trust for smaller investors available within the next 3 months, we hope. Who provides liquidity? Sygnia provides liquidity for the OSI fund. The demand for OSI shares is such that should we need to sell OSI shares, which I never envisaged doing, by the way, the liquidity is available in the market. There is now a market in OSI shares as people have woken up to what this company truly is and what value it represents. Literally yesterday, we had an offer for our entire shareholding in OSI coming from offshore investors. I don't know if, because the Vision Fund, which is the fund run by SoftBank, which is $100 billion fund, and they made us an offer for all of our OSI shares. They wanted to buy all of them, which obviously we're not interested in selling. We are buyers, not sellers. So there's full liquidity. Yes, the OSI investment is available via a retirement annuity. Does Sygnia own shares? Sygnia doesn't own shares in OSI. We only hold the shares on behalf of our investors. So there's no conflict of interest. And just to reassure you, where I have invested in the Sygnia OSI fund, I pay the same fees as anybody else. What changes do I anticipate to Regulation 28? Bruce, I anticipate potentially a requirement for deployment of portion of fixed interest, an increase in fixed interest allocation to be deployed into a COVID-19 bond issue. It's something that's being debated. And what is being debated is, should the government launch a COVID-19 bond? So it's kind of a solidarity bond. If they launch that bond, so they're raising money for the COVID-19 crisis, should investments by retirement funds be voluntary or mandatory? And if mandatory, what else can you massage? What can you put on the table in exchange for making something mandatory? So one of the suggestions is that offshore exposure gets increased to 40% from 30%. And there are, you know, different people arguing on different sides of this fence. I think at the moment, making this a voluntary investment for pension funds is the leading way of thinking, but I think that will very much depend on whether they are able to raise money from IMF, World Bank, because, you know, it's one thing to put a 500 billion rand package on the table. From what I know, and I do have access to a lot of information, but, you know, that's the wishful thinking number. That is not a number, that is, they don't have the cash right now. This is what they're trying to raise from various institutions, IMF, World Bank, BRICS Bank, and so on. This is what they need rather than what they have. So if that money is too expensive internationally, they will have to start looking at pots of money in South Africa. And then, Vickers, how do you change IFA's view to blend Coral, Ellen Grain, 91, etc., to get a benchmark at active fees rather than buying index tracking balanced funds? Because I intend to talk and talk and talk and talk and talk and make things as public as I possibly can about the silliness. Because, you know, it's one thing to choose a manager and stick with a manager, but this concept of blending managers, and, you know, and that's a concept that was promulgated by investment consultants, and the theory behind blending of asset managers goes as follows. You appoint different asset managers with different investment philosophies who will perform differently in different market cycles. So at a time when Ellen Gray is at the bottom, 91 will be at the top, and vice versa. Market cycle changes, 91 at the bottom, Ellen Gray at the top. What does it mean for you as the investor blending those managers together? It means that you are average. It means your performance is always average. And then you've got to deduct the active fees that you're paying for that privilege of being average. So I do believe that, you know, with sufficient amount of marketing, sufficient amount of talking, sufficient amount of exposure, you know, the market will open up to passive strategies. And I truly believe, and I'm running another seminar Friday, I think, on passive investing versus active investing. But I do believe that, you know, the people who should be standing up and answering the question of why are the active managers. So it's not really why passive. The question to ask is why active. And I think that brings all the questions to an end. Thank you so much for participating in this webinar and listening to me. Stay healthy, stay safe, keep yourself safe. We are going to be going through some tumultuous times in South Africa and some very sad times for all of us. And I think, you know, it will take huge amount of fortitude. Those of you who are trustees of pension funds, you know, you will be faced with some very difficult questions that you will need to answer. You know, we will try to stay as engaged with you as we possibly can through this period. We will run more webinars, we will talk, we will answer questions. Please email us if you have any questions. We are always here. We are an essential service. So we are working through this crisis, and wherever we can help, we will help. So thank you very much once again, and I hope to see you in the next webinar.